Hi, it's Saturday, May 14th, 2016. I'll be talking today about the U.S. Treasury yield curve. It might sound a bit arcane and very technical, but I think it's going to help a lot of people, because looking at the yield curve can give you a hint of what the biggest financial market in the world is thinking. All the sophisticated institutional investors, hedge funds, because the treasury market and government bond markets across the world are much bigger and more sophisticated than the stock market. And the reason I'm talking about this is because there was an article yesterday on Zero Hedge of how the U.S. Treasury yield curve crashed. And what they mean by that is that the yield curve flattened, which means that the yield of the 10-year dropped more than the yield in the 2-year in relative terms. So the difference between the 2-year yield and the 10-year yield is like narrowing. And there's an interesting chart on Zero Hedge, and I'll put the article to the link to that article on below in the video. And if you look at it, since the beginning of 2014, the spread between the 2-year note and the 10-year note has gone from around 250 basis points, or 2.5%, to the lowest it's been now, the lowest it's been since the beginning of 2008, which is around 95 basis points, or just under 1%. And what that means is that the investors in treasuries and in the bond market in general feel that the economy is slowing down. And another interesting point about the yield curve is that we could even get an inverted yield curve, which means that short-term rates are higher than longer-term rates, and usually that points to a recession. We're not there yet because we're still, at 95 basis points. We'd have to go to less than zero. We'd have to see, the 10-year yield drop below the 2-year yield. Usually that means it's a sign of overheating in the economy, and short-term rates get higher, and the longer-term rates are pointing to a recession and a slowdown going forward. So the article on Zero Hedge also compares what happened from 2004 to 2009, how the yield curve, the 2s-10s yield spread dropped. And it looks like from 2012 now to 2016, we're going the same way. So this is quite interesting. I've spoken in my previous videos about how other indicators are pointing to a U.S. economic slowdown. Jobless claims this week soared. The non-farm payroll number was a lot weaker in the beginning of the month. GDP for the second quarter came out at 0.5. It was expected higher, so almost pointing towards a recession. So looking at the yield curve is very interesting as well. So this is another very good indicator that the economy is slowing down. The fact that the curve is flattening. That's how people call it in the treasury market and financial markets. The curve, the 2s-10s are flattening. That means the difference between the 2-year yield and the 10-year yield is narrowing. So that's not a very good sign. It's basically saying that the Fed is already, by raising rates by a tiny 25 basis points in December, it's already putting pressure on the economy. So this is another factor pointing to no more Fed rate hikes, in my opinion. And there is a page, because you might ask, how can I keep track of this? Oh, it's very easy. I'll put a link to the Bloomberg.com website, and it's got all the treasury yields from 3-month, 6-month, 12-month, 1 year, 2-year, 5-year, 10-year, and 30-year. and you can compare. You know, you just take the 10-year yield and you track it every week. At the end of the week, you track the difference between the 10-year and the two-year yield. Right now, the 10-year yield is 1.7 and the 2-year yield is 0.75. So the difference is 95 basis points. So, you know, keep tracking it every Friday. You know, even if the yields go up, you could see the curve flatten because the 10-year yield might go up less than the 2-year. So it doesn't necessarily mean that just because yields are going up that you can't see the curve flattening. So yeah, that's what I recommend, you know, to the average person who's not a market professional. Keep an eye on the Treasury yield curve and the spread between the 2s, 10s. If you continue to see that spread narrowing, that's a bad signal for the economy. Instead of just looking like, you know, like most people do at the Dow Jones Industrial Averages and see if that's doing well in stocks. Yeah, give yourself a little bit of an edge and look at the U.S. Treasury yield curve. I hope that helps. If you like my videos, please subscribe. If you like this one as well, give me a thumbs up and share it with friends. You know, let's get sophisticated in investing. You know, why shouldn't we look at the yield curve? Take care. Have a good weekend. Bye.